Hey everyone, welcome to the weekly review. So things have been bullish the past week or so, and it's getting to a point where the momentum hasn't really materialized. We have earnings starting next week with the first of the Max 7 with Tesla, Meta, Microsoft. Also have ASML, have Intel, Apple afterwards, and we are at a big moment in time. I'm sure you guys saw the DeepSeek news over the weekend and the increasing discussion around it, and the fact that uh, AI models can be trained with much less money, and it has the potential to pop the bubble. I talked about this a couple of weeks ago, or more than a month ago, when it first showed up. And this week there were some news on the internet about Meta kind of panicking, or the AI companies kind of panicking about it. And with earnings coming up, I'll start by saying that if any of the big ones like Tesla is also with AI or XAI, they will talk about XAI there as well. But if Tesla, Meta, Microsoft, any of these three announce a reduction in uh, capex for next year, I think there's a chance the bubble pops because reality will finally hit everyone and they will realize that there is no money in AI. I've said it before that I think the model that would be successful, like a successful product that the users use, is something that will run locally on your device, be it a laptop, PC, a phone, because they're comparably powerful compute-wise. So the whole approach that the US companies had was wrong from the beginning because they tried to make it by default a cloud service which you need to subscribe to, and that was their intent in making money. Like you make a cloud service, you subscribe to it, and you make money from the subscriptions. But this is wrong by default because the model has to run locally, use your own energy and compute, and only something like subscribe to that database or you update it regularly. Maybe you pay for it for the update in the database, you have up-to-date data. Maybe there's a subscription as well there. But anyway, the whole idea that this has to be in the cloud is wrong by the from the beginning. It has to be on your local machine to be successful. The fact that things are open source now makes even paying for that model that you download one time kind of iffy. So I don't think that's even on the table now. So if that becomes reality and because of this reality hits them and they reduce investment in GPUs and stuff like that for the next year or so, then the bubble might pop. Uh, this being said, let's look at some other stuff as well. I'll start with the market breadth, uh, the custom one I use from positioning. And I want to show this is percentage of stock with positioning rating that is positive, neutral, or negative. Red is negative, blue is positive, green is neutral. Neutral meaning equals to 0, positives greater than 0, and negative less than 0. So what I want to show is that uh, as a bull market progresses, we see generally positioning deteriorating, like more and more stocks go into negative, and this can last for a long time. Like for example, in the 2020 to 2022 run up, we see this deteriorating over and over again, and it gets lower and lower until eventually we have the correction. Same here in 2018, like we see a deterioration and on a negative divergence as the market goes higher, eventually we get a big correction. In the 2020, right before the COVID crash, again we saw a large negative divergence here, and eventually we broke down. The 2020 top, when Tesla announced the stock split, same kind of thing, like we had a negative divergence. In the top in 2022, negative divergence, and a significant one at that. And currently we look a lot like this. And let's go to today. And what we see, also here, what we see is the amount of positive stock is at a cycle low, considering we are at a high. So again, we have a negative divergence here. Stocks made a new high, but the amount of positive stocks is at a cycle low, basically, for a push into all-time highs. And this is concerning. This is the difference between positive and negative. Again, like a huge negative divergence here. We kind of have the same thing before COVID. We kind of have the same thing for before the 2022 top. This being said, going back to stocks, I'll show UVOL and DVOL next. And as you know, I use this as a momentum indicator. Like for example, when we get a 90 DVOL, and we did here, even though it's not tracked, actually I'll switch to the other one because that one will show it. Wrong one. I used to open the same one. This one. So we had a 90 DVOL, and then we had an 80 here, but so this is 80, and we had a 90 DVOL, we had an 80 afterwards, but what we need is back-to-back 80s, or not necessarily back-to-back, but within like 3-4 trading days, we need to have two 80 UVOL or an 90 UVOL to cancel this one. And we had an 80, but afterwards there's no follow-up. So even though market push higher, it didn't do a breadth thrust. So no breadth thrust, no belief that this is going higher. And on the weekly, on RSI, we have a continued negative RSI divergence. Like things are not shaping up to be bullish, in my opinion. We had the potential to prove the bullishness, but the bullishness hasn't been proven, and the amount of things that have been happening is quite scary, if you ask me. Now, combining everything together, like each individual sign is not that scary, but combining everything together, they paint a scary pictures. Like you can see VIX having this bottoming look at, similar to here, like we have the same look, kind of 15 is a floor. In positioning for VIX, the price line is wrong here because we have a bug, but it should be here, like just below 15. And we are at in a place where we basically cannot go lower. And we have massive earnings. We have negative divergence across the board. We have VIX at the low. Like things are painting a bleak picture. The question is how impulsive a move down will be. And I will talk about the bullish and bearish scenario. Just to we have I'll go this list of negative prints that in this distribution range, and if we lose this, I think we flush down, like I said, on blue sky. Now, again, everything added together paints a bleak picture, and let's talk about the bullish and bearish scenarios now. I'll remind you that I copied this. So I took all the candle bars from here, added them here, and I said that in theory this is not that that bearish short term. But again, if earnings come and they announce a reduction in AI investment, well, the bubble has a high chance of popping. And if the bubble pops, we are going way, way lower than what I drew here. Like bubble popping is not a fast, uh, a slow, a slow drop. Bubble popping is like minus 20% on the index, then a bounce, then maybe potentially we go lower, like at the beginning of a new bear market, if that comes. But if the market drops short term, like if we do something like this, almost exactly like this, and we attempt to go down, but then buyers step in, then that will be potentially a signal that the market can go higher. Like even if the initial reaction for earnings will be like when is earnings? It's on Wednesday here. So this is when it should happen. Like we go down, but the next day, like we even go down here. But the next day, buyers step in, like we have a huge gap down, but buyers step in and we close, let's say around here. Then we have a green candle, an attempt to push lower, but we probably go from 90 D vol to like plus 80, plus 90 U vol, something like that. So we do an intraday reversal of epic proportions. If this happens, then the bull mode stays on and we go higher. So this the next time we try to attempt to go higher, we actually go higher, in my opinion, if we get this kind of reversal. If we get a dump and continuation, obviously we go significantly lower. The kind of not good scenario is one in which we get meh reaction. Like, let's say we drop here, we try to go lower, but we don't go lower. We try to go higher, but we don't go higher. Like, this consolidation scenario is actually bearish. Like, considering where we are here, a lack of bullishness is bearish. Lack of bullishness, like the bulls have to step in and push price higher. If that fails to materialize, we continue consolidation, but it's a bearish consolidation because this whole area, like from the election or from this whole level, the Q20, the Q4 or the election gap, like this whole area becomes a distribution area, and we will go sideways a couple of times through it, but ultimately things are likely going to get worse as time passes, not better. Maybe the next couple of CPI prints make us bullish again, but again, if that doesn't materialize, we are destined to go sideways. Bulls won't like it, bears won't like it, and eventually I think we get a breakdown. Like it's more likely to get a breakdown, even if CPI is fine, um, even if capex stay the same, something like that. And we should go to like 550. Like we actually get that slow correction maybe to something like this, 540, 550, and then we see. But it's kind of complicated. I think we get the resolutions faster. Like either we go down, it gets bought up, and then we push higher, or if we go down for good, and that's all she wrote basically. But yeah, that's kind of it. Breadth wise, we are near highs again. Like if we begin a correction from here, it's going to be brutal. The other breadth indicator have to be on daily. You can see it's turning, it's curling down again, and we didn't even get to previous highs, so not that good either. This is McLaren oscillator, and we had a high here, and now we make new highs on a bearish divergence as well. This is money flow index, and we haven't had this type of bearish divergence since the 2022 top. like a super high here and then a much lower high. Now we went almost to the highest level we went a couple of times before, and now with a much lower high. So again, bearish divergence. Uh, what did COVID look like? Yeah, same thing, like a big spike and now a significantly lower high. So things are looking a bit scary right now. I I would like to see a breakout, but it will depend on earnings, and that's all there is to it. I expect early in the week we will just go get sideways, so this is a good description. Like maybe we don't go to 603 or something like that, but we just go sideways until we get earnings. And once earnings for Tesla, Meta, Microsoft come in, it will depend on that. And I think the key here is how much money they will spend on AI. If they don't reduce uh, their spending for GPUs and stuff for AI investment, the market will like it. We can continue going higher. Obviously, we can we push we get push the ball until the next quarter. But eventually, like reality will hit all of these companies, and they will reduce spending. And when they reduce spending, the bubble will pop. And the signal, I'll remind you what the signal was for the 2022 top, and it was Meta. They had been doing relatively badly for a while, and then we had this 26% day on earnings. Like when one of the Max 7 companies does this, like a minus 20% day, then the bubble has popped. Until then, if we get minus 7%, who cares? Like it's just a bad day. They can recover, they can go down. Like Max 7 doesn't mean it's immune. Like we had Apple, and it's no longer at the top, but it was a slow drop. It's more likely that we get a bounce here than anything else. But again, depends on earnings. But like a bad outcome for Apple earnings would be like go from 220.22 to 180 in a single drop. How much is this? 20%, yeah, about right. So it would have to go down here in a single move, then you'll probably bounce to 200, but then very likely it will continue lower, something like this. But yeah, you get the idea. We have Microsoft, which is near highs. We need like a huge drop. If we see a huge drop because of earnings in any of these companies, something like this from Microsoft, Meta is near highs. Meta is the most appealing candidate because um, I think it's a better signal than Microsoft. Microsoft has a conflict of interest because OpenAI, but Meta is more ruthless, and they caused the bubble to pop in 2022 as well. Like if it comes from somewhere, like cutting expenses and saying, okay, we're done investing in this as crazily as we have until now, I think it's likely that it comes from Meta. So if we see Meta dumping 20%, obviously the market will join it, and not 20%, but it will be like a minus 3-4% day on SPY, minus 5-6 on QQQ. Then you know this shit is real, and that's the signal to go short. It's not a signal to go short as it moves higher because it can always move higher. But if we get this kind of signal, even if we get a bounce, like we open here, we get a bounce maybe as high as 585, but it's very, very likely that new lows will come in later. We will fill a couple of these gaps here. We have from the past, we have a gap here, we have a gap here. I don't think this will get filled anytime soon, but this one is definitely a target. So if we get the bubble pop scenario, I could definitely see Meta close this bubble at 400 and then have a bounce a bit later. Yeah, it was a bit doomy, but this is the context. Again, wait and see. I'm not saying to do anything to try to front run this. Wait and see. If we get the bubble pop scenario because earnings, go with that. If we get the party continue signal, go with that as well. But I think it's better to wait and see than anything else in this context. Hope it helps. Have a good one. Bye bye.